February 10th, 2026, 10 a.m. Eastern Time. Crypto markets look completely normal. Traders are relaxed, sipping coffee. Charts are calm. Algorithms are quietly doing their job in the background. Nothing feels unusual. Then, 30 minutes later, everything changes. By 10:30 a.m., over $40 billion has vanished from the global crypto market like it never existed. No warning, no headline, no hack, no scandal. Just silence. It wasn't a crash with an explanation. It was a crash without a cause. A ghost event that exposed something terrifying beneath the surface. Most market crashes come with a reason. There's usually a headline, a scandal, a hack, or a clear event that explains why billions suddenly disappear. When FTX collapsed, the world watched the fraud unravel. When Luna went to zero, everyone saw the algorithm break in real time. When exchanges get hacked, stolen funds move across the blockchain like footprints in snow. But February 10th, 2026 was different. That morning, the crypto market didn't crash with noise, it crashed with silence. In just 30 minutes, over $40 billion vanished from the global crypto market cap. Traders refreshed their screens in disbelief, waiting for the breaking news alert that never came. No government announced a ban, no CEO was arrested, no major protocol was exploited, no exchange reported a breach. The news feeds were empty, yet the market was bleeding. That's what made it terrifying. And this wasn't a robbery. This wasn't a hack. This wasn't even panic triggered by bad headlines. It was something much deeper. A structural failure that most investors don't even realize exists. For the first few hours, nobody could explain what happened. Analysts scrambled for answers. Traders searched for a culprit. People assumed it had to be some hidden exploit or secret scandal. But there was nothing. The truth is, the market didn't break because of one sudden event. It broke because the foundation underneath it had already been weakening for months. Since October 2025, crypto had been bleeding slowly. Bitcoin had peaked near historic highs, and optimism was everywhere. But by February 2026, nearly $2 trillion had already been erased from the industry. Confidence was fading, liquidity was drying up, buyers were quietly stepping away. The market looked stable, but it was fragile, like a dry forest that hadn't seen rain in months. In that environment, you don't need a massive explosion to start a fire. All it takes is a spark. February 10th was that spark. And the scariest part is this. If $40 billion can disappear without news, without hacks, without warnings, then the same weakness could still be sitting beneath the market right now. What makes the February 10th crash so disturbing isn't just the $40 billion that disappeared. It's the silence that followed. In normal market collapses, there's always a trigger. A headline flashes across every screen. A scandal breaks. A CEO vanishes. A protocol gets exploited. Something happens that gives people a reason to point and say, that's why. But this time, there was nothing. No hack, no breaking news, no warning. Just a sudden, violent hole ripped into the market. For 30 minutes, crypto didn't feel like an investment market. It felt like reality itself glitched. Traders watched charts collapse in real time, refreshing their screens again and again, convinced they must be missing something. But they weren't. $40 billion was erased as if it had never existed. And that raises a terrifying question. If wealth can vanish that fast without an obvious cause, what is this system really built on? Most people believe markets move because of emotion, fear, greed, panic, hype. They think prices fall because of bad news and rise because of good news. February 10th proved something darker. Sometimes markets don't crash because of headlines. They crash because the structure underneath them is empty, like a bridge that looks solid until the moment it collapses under your feet. This wasn't millions of retail traders panic selling from their phones. This wasn't a social media frenzy. Something deeper was happening beneath the surface. Liquidity was disappearing. Buyers were stepping away. Whales were quietly exiting before anyone noticed. And the market was being held up by nothing but fragile confidence and automated machines. Because once liquidity dries up, markets don't fall slowly. They drop straight through the floor. The February 10th wipeout wasn't random. It was the result of weeks of tension building, of cracks spreading quietly through the system. The market had been bleeding for months. Prices were grinding lower. Hope was fading. Institutions were no longer rushing in to buy dips. The safety net was thinning. And then, on that Tuesday morning, the spark finally hit dry wood. The crash wasn't just a bad day. It was a warning. A glimpse of what happens when buyers vanish and algorithms take over. To understand why this happened, and why it could happen again, you have to rewind. Because the silent crash didn't begin at 10:00 a.m. It began long before that. 3 days before the February 10th wipeout, the first crack appeared. February 7th, 2026. A major exchange, Bitham, reported what initially looked like a routine mistake. Not a hack, not an attack, just an error. A fat finger incident. Someone, or something, accidentally moved an enormous amount of Bitcoin, nearly $40 billion worth, in a way that wasn't supposed to happen. For a brief moment, chaos erupted. Traders stared at the blockchain transaction like they were watching a plane fall out of the sky. Social media lit up with speculation. People assumed the worst. But then the exchange recovered the funds. The mistake was corrected. The headlines faded. Technically, nothing broke. Psychologically, everything broke. Imagine walking across a frozen lake. The ice holds, but you hear a loud crack beneath your feet. You don't fall through, but every step afterward feels dangerous. That is what the Bitham incident did to the market. It didn't destroy confidence instantly, but it reminded everyone how fragile the system really was. And the market was already fragile. Zoom out beyond that single exchange error and the bigger picture becomes obvious. But by February 2026, half of that wealth was gone. $2 trillion erased in 4 months. Not in one dramatic crash, but in a slow bleed. Day after day, prices grinding lower, hope draining out of the charts, retail investors growing exhausted, institutions quietly stepping away. The market was no longer a fortress. It was a dry forest, brittle, overheated, waiting for a spark. And the spark didn't need to be large. In a fragile market, disaster doesn't require a massive scandal. It requires emptiness. That emptiness had a name: thin liquidity. Liquidity is the market's safety net. Normally, when someone sells Bitcoin, buyers are waiting below. If you sell at $90,000, someone catches it at $89,950. The price dips slightly, then stabilizes. The market absorbs the shock. But in early February 2026, the buyers weren't there. Fear had chased them away. The Bitham tremor made investors nervous. The months-long decline made institutions cautious. Stablecoins were being redeemed for real dollars. Dry powder was disappearing. People weren't just rotating from Bitcoin into USDT. They were leaving crypto entirely. They were cashing out and exiting the casino. So by the time February 10th arrived, the market looked calm on the surface, but underneath it was hollow. The pool was shallow. The safety net was cut. Then, at 10:08 a.m., the selling began. At first it was small, a 1% drop, normally meaningless, a normal Tuesday in crypto. But in a market this fragile, 1% was enough. Because the market wasn't being driven by humans anymore. It was being driven by machines. Algorithms detected weakness instantly. Trading bots triggered stop-loss orders. Automated systems began selling to protect positions before losses grew. But remember, there were no buyers waiting. So the first wave of selling pushed prices down harder than expected. That drop triggered the next layer of automated responses. More stop-losses fired. More bots sold. The dominoes began falling. Bitcoin dropped 2%, then 3%. Altcoins fell faster. Ethereum slipped sharply. Solana tumbled. Smaller projects collapsed even harder. And then came the real killer, leverage. Crypto in 2026 was built on borrowed money. Traders weren't betting with what they owned. They were betting with 10 times, 20 times, sometimes 50 times leverage. They were convinced the bottom was in. They were convinced the bounce was coming. But leverage is a trap, because when you borrow that much, a small move becomes fatal. A 3% dip is not a dip anymore. It is liquidation. Exchanges began issuing margin calls. Put up more collateral, or your position will be sold automatically. Most traders didn't have extra collateral, so the system sold for them. Forced liquidations hit the market like a hammer. Positions were wiped out instantly. Traders didn't choose to sell. They were erased. And that created the feedback loop from hell. Selling caused liquidations. Liquidations caused more selling. More selling drove prices lower. Lower prices triggered more liquidations. Round and round it went, faster and faster, like a waterfall accelerating over the edge. Within minutes, billions in futures positions were destroyed. This wasn't just numbers on a screen. This was real collateral, real savings, real paychecks, transferred from the impatient to the prepared. By 10:30 a.m., the smoke cleared. $40 billion in market value was gone. And the most disturbing part was this. The system worked exactly as designed. There was no hack, no exploit, no villain. The market didn't fail because of a glitch in the code. The market failed because of a glitch in the structure. And the buyers had vanished. Liquidity was gone. Leverage was stacked like dry wood. Algorithms were the match. The February 10th crash wasn't an accident. It was inevitability. It was the market revealing what happens when confidence disappears and machines take over. For years, investors believed crypto was unstoppable. They believed every dip was opportunity. They believed the market would always recover. February 10th shattered that illusion because it proved something terrifying. In the right conditions, wealth doesn't fade slowly. It evaporates instantly. And the weakness that caused the silent crash still exists beneath the surface today. So if there was no hack, no scandal, no breaking headline, what actually caused the February 10th silent crash? The answer is uncomfortable but simple. Money became expensive. For years, crypto lived in a world of cheap liquidity. Interest rates were near zero, cash felt useless. Holding dollars gave you nothing, so investors chased risk instead. Bitcoin, Ethereum, altcoins, anything that promised explosive returns. Crypto didn't thrive only because of belief. It thrived because money was easy. But in early 2026, the environment changed. The Federal Reserve acknowledged that interest rates would stay high longer than markets expected. And in finance, high rates are gravity. When rates remain elevated, the dollar strengthens. When the dollar strengthens, risk assets suffocate. The whales understood this immediately. They didn't sell because they suddenly hated Bitcoin. They sold because the math stopped working. Why gamble on an asset that can drop 20% in a week when you can earn a guaranteed return in risk-free bonds? That shift in incentives triggered a quiet exodus. And the clearest evidence wasn't on the Bitcoin chart. It was in the stablecoins. Most retail traders ignore stablecoin supply, but stablecoins are the bloodstream of crypto markets. USDT and USDC are the poker chips of the casino. Even if you aren't playing, as long as your money's in chips, you're still inside the building ready to deploy capital. But in January and early February, those chips started disappearing. Investors weren't just selling Bitcoin into stablecoins. They were redeeming stablecoins for actual US dollars, wiring money back into bank accounts, leaving the casino entirely. That meant the market was losing its dry powder. Dry powder is the sidelined cash waiting to buy dips. In a healthy market, a large sell order gets absorbed by thousands of buyers. The price shakes, then stabilizes. But on February 10th, the buyers were gone. Liquidity was paper thin. Market depth is like water in a pool. In a deep pool, a cannonball creates a splash, but the water holds. In a shallow pool, the same cannonball empties the entire thing, and you hit concrete. That's what happened. The selling wave hit a market with no depth, and prices fell straight through the floor. Then leverage turned the fall into a cascade. Crypto in 2026 was built on borrowed money. Traders were using 10, 20, even 50 times leverage, betting that the bottom was in. They were convinced the bounce was coming. But leverage is fragile. A 3% dip becomes liquidation. Exchanges issue margin calls. Traders don't have more collateral, so the system sells for them. Forced liquidations create a feedback loop from hell. Selling triggers liquidations. Liquidations trigger more selling. The price drops harder. More traders get wiped out. Within minutes, billions in positions were erased. This wasn't panic. It was mechanics. And that's the terrifying part. The system didn't malfunction. It worked perfectly. The crash wasn't caused by a single villain or event. It was caused by structural weakness. Thin liquidity, expensive money, and leverage stacked on top of hope. February 10th wasn't just a bad day, it was a warning. Because if $40 billion can vanish without news, without hacks, without scandals, then the same silent trapdoor could open again anytime liquidity disappears. And next time, it may not stop at crypto. So what do you do with this information? You stop thinking like a gambler and start thinking like a survivor. Because the rules of 2024 and 2025 don't apply anymore. This is not an environment where leverage is rewarded. It's an environment where leverage gets you erased. Cash is not weakness right now. Cash is optionality. Cash is the ability to wait while others panic. The investors who survived February 10th weren't the ones who bought the dip. They were the ones who stayed patient. They watched the knife fall. They didn't try to grab it midair. And if you're holding crypto today, ask yourself one question. Are you positioned for upside, or are you positioned to survive downside? Because the market is designed to find your breaking point. It will grind lower until the last hopeful buyer gives up. That's usually where bottoms are born. We may not be there yet. And the scariest part? The structural weakness that caused the silent crash still exists. Thin liquidity, high rates, whales exiting, algorithms waiting. So don't just stare at candles. Watch the liquidity. Watch the stablecoin flows. Watch the heat map. Because the next flash crash won't come with news. It will come with silence. And here's what most people still don't realize. February 10th wasn't the crash. It was the preview. The market didn't break because of one event. It broke because the buyers vanished. Because the safety net was gone. Because the system is more fragile than anyone admits. And right now, that same void is forming again. Not just in crypto, but in tech stocks, in the NASDAQ, in the broader financial system. There's a liquidity heat map that predicted the February 10th wipeout days before it happened. It showed the air pocket, the empty bids, the trapdoor. And today, that SME indicator is flashing red somewhere much bigger. Somewhere that doesn't just wipe out traders, but wipes out retirement accounts. The question isn't, will there be another flash crash? The question is, where will the void strike next? Because when liquidity disappears, markets don't fall slowly. They fall instantly. So before you place your next trade, before you buy your next dip, you need to see what the charts aren't showing you. You need to see where the buyers are missing. Because the next 30-minute window could erase years. Click the next video I'll show you the liquidity heat map for the S&P 500. And the exact week the algorithms are warning about. Don't wait.